Good morning. Welcome to the morning market briefing. Today is Friday, July 24th, 2026. Hope you are doing well. Almost the weekend. I am riding solo today, but we do have a lot to get to. Trump is talking about, he's losing patience. He's talking about more Iranian attacks. We'll talk a little bit about that. We're going to talk about the tariff situation. More tariffs are coming on, although they're just really replacing tariffs that have come off. We're going to talk about Intel, which was ripping until they said that they're going to spend a lot of money on CapEx. And then we're going to give you a little preview of the week ahead. We have some big earnings reports. Wednesday evening is going to be just, I think we might just do an all-nighter. I think the analyst team doesn't know it yet. But I think I'm just going to order pizza and lock the doors and keep them here for the duration, because we have Microsoft, Meta, Qualcomm, Starbucks, Railroad Canadian Pacific, we just have Chipotle even. Thankfully, we don't own Chipotle, but that company is reporting next week. To kick off, though, let's start on the war front with rates. And I made this point yesterday, and I just want to emphasize, because I think repetition is important here. And that is the big negative from the war as far as the economy is concerned, I believe, is not inflation. I believe it's the impact on interest rates and the impact on the national debt and the deficit. If we're spending an additional $800 billion, which is what 200 basis points in interest rates amounts to, if we're spending an $800 billion on interest costs, that's $800 billion less dollars that we can spend on national defense, paying down the debt, balancing the budget, meeting entitlements, and funding things like these Trump accounts, which have been widely touted as been a fairly successful program so far. And by the way, doesn't it cost a whole lot? $5 to $10 billion, I think right now is the estimate. And yet we're spending an additional $800 billion a year, assuming that rates are 200 basis points higher than they should be. So we've got that going on, and I continue to think that lower rates would be very helpful for the economy, for the national debt. But until we master inflation and get that under control, we're not going to be able to get interest rates down. So that's what we're going with this morning. As far as Iran goes, Trump is losing patience. There's a big Wall Street Journal article about that overnight. Apparently, at a recent meeting in the Oval Office, he launched into a tirade against the Iranian leaders, calling them scumbags and lunatics. He's increasingly frustrated because it was a conflict that he thought would be over in a matter of weeks. It's dragged on and on and on, and no end in sight there. He's expressed frustration both with his diplomatic efforts, but also with Bibi Netanyahu. I don't think that's a surprise. And all of it's resulting in his conclusion that there may need to be a, quote, massive attack on Iran to push the nation to negotiate a peace deal. He's apparently told Axios that they have not received enough pain yet. So I would suspect that is probably the course that's the war is going to take. I don't know if we're going to have a Friday kick save this time or a Monday morning kick save about a deal happening, which has been the trend over the last few months. We certainly could, but it doesn't seem likely. It seems there's been other times where it's been more likely. So that's the backdrop, which is all to say I don't think interest rates are coming down anytime soon. But again, that's all subject to change. And if we get some resolution on Iran, then that would be excellent news. We are starting to ramp up energy production here in the United States, offshore, in Latin America, and in other countries around the world outside of the Middle East. SLB, which was formerly Schlumberger, and they thought that SLB would be a more intuitive name, which I don't really think that's the case. I mean, it's just another acronym. But they said they actually reported pretty good earnings results. They are if you recall, we talked about this before, but they have an agreement with Meta where they're essentially going to help provide a lot of the drilling equipment that's going to produce the natural gas, that's going to power the turbines, that's going to power the data centers. And so SLB has its own data center business now, and it's going to be about 3% of revenue exiting the year. So it's gone from basically a zero to $1 billion revenue run rate in the space of 9 to 12 months. So that's good news for them. Stock is up on this, but very broadly an optimistic view. Offshore activity rebound in U.S. unconventional wells. This is good news, I think, for U.S. drilling activity, certainly for the economies of Texas, Louisiana, and potentially even Montana, North Dakota, if they can start revitalizing the Bakken as well. So that's good news here domestically, I suppose, as it relates to the war, but really just energy production in general. Sticking with the AI front, Intel did report as well last night, and their turnaround continues, but it does run the risk of stalling out a little bit here. They are doing well in the data center. They are doing well actually in just normal PCs. Where they're not doing as well is the gross margin side, which seems like it's hitting a bit of a ceiling in the low 40s. This is a company that used to have gross margin well into the 60s, but now that it's almost a gun-for-hire manufacturing operation, you see those margins much less. The other piece there is that they're going to really ramp up CapEx. This is probably done at the behest of entities like the U.S. government, which frankly saved Intel, and the U.S. government has made a lot of money with that investment in Intel, but it comes with the caveat that you got to go ahead and invest, and their capital expenditures were revised up by about 15% this quarter for the full year, and they said it's going to be significantly higher next year. So we do own chip equipment companies. We talked a little bit yesterday about understanding the underperformance in Q2 and what drove that, and trying not to chase the shiny object. But one thing that we did want to do is look for companies that are more durable and may be geared to some of the similar end markets, but have better moats around their business and are something that fits our investing playbook. And one of those companies is ASML. ASML is a leader in chip fabrication equipment, especially at the very high end, which is exactly what is needed right now. And so ASML should benefit as a result of these CapEx increases, not just at Intel, but also at Micron, at SK Hynix, at Samsung, at all of these companies. Whenever you see a CapEx increase, you should think that's good news for ASML. So that's how we think about it. Here at Narwhal, on the healthcare side, we did get a couple hospitals reporting to Tenet Health, which runs hospitals in California and Texas, reported. They also have a couple in Michigan. They reported actually very good numbers. The big theme on the hospital side, so we got two themes in healthcare right now. We have GLP-1s, and then we have this ACA change. And what we're seeing with the ACA change is about 20% or so of the people who are on those ACA plans are no longer on those ACA plans. That is being somewhat offset by an increase in Medicaid payments, which Medicaid obviously partly run by the states, but can be funded by the federal government as well. And so that's one thing. The GLP-1 theme is a longer tail theme that we continue to evaluate. This is the weight loss drugs. But as it relates to the ACA, there was some concerns that there were going to be a lot of people dropping off, the hospital volume and specifically reimbursement was going to be very low, because if people are paying out of their pocket, sometimes they don't pay. So you got to watch bad debt expense and things like that. And what we've seen at Tenet is that the offset there from Medicaid is helping to offset a lot of these reductions in ACA payments. But for HCA, so we got Tenet Health, THC, HCA, which is HCA, and then the Affordable Care Act, ACA. But HCA Healthcare operates hospitals in Tennessee, Florida, and Texas, and they're very concentrated, especially in Florida and Texas. And Medicaid reimbursement is lower in those states because certain of those states didn't really aggressively expand Medicaid like California did, for example. And so when these people are coming off the ACA rolls, it is more of a hit to companies like HCA. So HCA already pre-announced a bad quarter, but they also took down guidance this time around and kind of quantified that a little bit more. I think this is going to be continuing to weigh on the hospital stocks and really the healthcare system in general over the next period, 6 to 12 months or so, until that starts to roll over. We also got some news on the consumer today. American Express was fine, not really too dissimilar from anything that we've seen from other companies. Credit card issuers in the space, delinquencies again, like Capital One, like Synchrony, like a lot of the big banks, delinquencies came down. Credit quality is improving. American Express is far and away the highest quality of customers in terms of delinquencies. Their delinquency rate fell to 1.2%, which is remarkably strong. So good news on the consumer front today as well. American Express is spending a lot of money on marketing, so their stock is down a little bit, but it's had a really strong rally. I'm not too surprised by that, and I think that if it dips much more, we'd probably be buyers of that stock. Looking ahead to next week, the big thing is a big day is Wednesday. So if you don't care about anything in the markets, care about Wednesday. We've got a Fed rate decision on Wednesday afternoon. We have Procter & Gamble reporting in the morning. We have Old Dominion Freight Lines, which is the biggest LTL carrier in the United States, and really the blue chip there. We have Vulcan Materials. A lot of people are interested in how the industrial side of the economy is going. Vulcan Materials supplies a lot of aggregates and rock to the economy, to road building and construction and things like that. So we have Vulcan, Procter & Gamble, Old Dominion Freight in the morning. We have the Fed rate decision in the afternoon. We have Microsoft, Meta, Qualcomm, Starbucks, Canadian Pacific, Chipotle, O'Reilly Auto Parts, and FICO, all in the evening. FICO, of course, the credit bureau that has been under pressure because people think, well, why do I need a credit bureau if I can just use AI and analyze people? We're not there yet, but in 2 or 3 years, maybe we're going to be there. So how FICO fends off those questions will be interesting. On Thursday evening, we also have Apple and Amazon. Just two small companies over there, Hicks, that you may or may not have heard of before. I think the big thing on the Fed rate decision, I'm going to give you a quick preview right now, but Tom will be back in on Monday, and he'll be able to shed a little bit more light here. But my view is that we do need some Fed rate cuts. For the deficit, I think that we have the ability to do that because of inflation. I think that the economy is actually in pretty good shape right now. I don't think we need to, although it would probably help the housing market. But I think we probably need to from a deficit standpoint. And I think that we can afford to because of where inflation is. So that's my view on interest rates. It's a little bit nuanced versus just looking at the economy and looking at inflation. But I think it's worth considering, especially now that you have the 30-year well over 5% again and the 10-year at 4.7%. That's a big interest cost. My mortgage is at 3 1/8. So the U.S. government is paying almost double, certainly 50% more on their borrowing than I am. I'm happy with that from my personal standpoint. I'm not happy from a citizen's standpoint or with any concern of my child inheriting that debt over the long period of time. I think Kevin Warsh understands this. Rick Reeder spoke at the CFA conference about a month ago, and he says that Kevin Warsh understands this. And he's talked to Kevin Warsh. And whether or not Kevin Warsh can get everyone else on board is going to be another question. So I don't expect the Fed to do much. I expect a modest update to some of these task forces, but I don't expect Kevin Warsh to really plant his flag on either the rate cutting side or the rate hike side, at least not yet. I think that he will be at Jackson Hole at the end of August, the Jackson Hole Symposium. That's usually a bellwether event for Fed governors and Fed presidents and Fed chairmen over the years. I expect that if there's any big news that he wants to make, it'll probably be there. It's not going to be at a normal Fed meeting that happens every 6 weeks, and I don't expect any change to interest rates this time around. With that, I hope everyone has a great weekend, and we'll be back here at 8:30 on Monday.